as big as the commercial real estate and real estate investing world is, when you really break it down, it's relatively small. And if you do the wrong thing once, that's going to get out there.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik. With me, as always, is John Cohen. How we doing?
You're good. We're hanging in there. Just another day. Nice day outside. The weather's getting nice out, and we'll see what happens.
Yeah, absolutely. No, it's a interesting time. Weather's getting nicer, so that's always nice. Got to figure out now that I'm out east where all the beaches are and which one I need to go to. So maybe this weekend I'll figure it out. But it's a good time to be out in Long Island, not in the city. So I'm happy about that. At least there's some silver lining. So. Be that as it may, though, got a really great guest on today. Really excited to hear his story and get his insights and experiences and stuff he's done. Just interested to hear it. I got nothing else to say. But with that being said, Lane, thank you so much for coming on the podcast.
Hey, thanks for having me, guys. Appreciate it.
You want to take a couple minutes, just tell everybody a little bit about yourself, who you are, where you're from, kind of your journey, and what you do?
Yeah, sure. So today I own over 3,500 units, invest in multifamily, most in the southeast, but took me over a decade to get there. Mm-hmm. So my story kind of starts off, I graduated college in 2007. I think like a lot of working professionals, we're programmed from birth to go to school, be a good kid and get a good job and work with that job for 40 years. For some strange reason, I was good at math and science when I was like 9. So I was told to be an engineer. So that's what I did. I became an engineer. And then I, again, programmed to go buy a house to live in. And which I don't really agree yet. I don't really do that today. I rent. But I went and bought that first rental back in 2009. And for a 20-something-year-old kid, that was a lot of beer money. The rents were $2,200 a month. The PITI was $1,600, and I was like, "Whoa, I gotta keep doing this to get out of this stinking rat race."
Mm-hmm. And what happened from there?
So I pretty much did nothing for a year and a half because you gotta save money. I was a working professional engineer. I was busy. I didn't have time to do all this nonsense you see on like other, websites, all this burr stuff. So I just saved my money. Luckily, I had a pretty good paying job and I was pretty frugal back then. I was able to save maybe like $40,000 or $50,000 a year. So I was able to buy a duplex in the next couple of years. And first property was in Seattle. Second property was in Seattle also. But then I realized that those properties don't cash flow. They don't meet the 1% rent to value ratio. So I started to invest out of state remotely in Birmingham, Atlanta, Indianapolis. And over the next 5-6 years, I had about 10, 11 rental properties all over, 3-4 states. And that was kind of my first plateau. And I realized, I think you guys probably, had the same realization that these little single family homes, great way to get your net worth up to $500,000, but man, are they a pain?
Mm-hmm.
They're just not scalable. So that was kind of where I pivoted to more to multifamily and syndications.
Yeah, I think it's interesting to hear you, just another example of somebody that started out with their own capital, and it's not a quick process. It's not, I'm going to buy 5 homes in the first year. It's I'm going to buy one and then, okay, I have one, but now I've got to save up again. And now you're saving from your regular job plus a little bit of cash flow. But then, it takes a year and a half to do the second one. And then you got to save up again. Now you got a little bit more cash flow. And then, maybe in another year and a quarter, you can buy the third one. And I think too often people think I can just get into this and do this crazy creative financing or these crazy burr structures. And I'm just going to own tons of homes, tons of investment very quickly. And it's great to hear, you've said you've been doing this for over a decade. And it's taken you that long to get to the point where you're at now. Like you said, over 3,000 units you're invested in. I'm sure 2/3 of that came in the last couple of years or the last few years rather than, spread out aggregately across the last 10, 12 years.
Yeah, you're exactly right. It's the whole hockey stick. I mean, I see a lot of kids, they're getting started and they have a lot of resources and they're kind of ballsy, in my opinion, the way they do it. They do the creative financing, they do the burrs. But I mean, that stuff works until it doesn't. And you only hear about the success stories on the online forums and all these stories from these other guys. And, that stuff is a little bit more risky, right? I would say a lot more risky. And then if things happen in the economy, you kind of go back to zero. I mean, I'm not saying that my way is the way to do it, but the way I did it, there was really no risk in doing it my way. I mean, just buy rental properties at cash flow, as simple as that. But yeah, it did take freaking forever.
I believe it. No, I think it's important too, because one thing that I think is not talked about is because I get beat back on so many people that have done creative financing, so many people that have done burr, and if you do it the right way, it can work. But what happens is to get those deals and to make those deals work, you're trading time instead of capital. And you could have very easily, the hours you spent finding, putting together that deal, operating that deal, you could have worked at something else, made the money, saved that money, and then invested it into something that just cash flows day one. And I think too often people just look at it as, oh, it's money for free, right? I got creative, so I got free money. I got a free deal. I burdened, I got all my money back for free type of thing. And that's not the case, because it takes a lot of work. It takes a lot of leverage. It takes, a lot of time to find these deals. And like you said, it doesn't always work out nearly as well. In my opinion, it's much more riskier than just buying a deal that automatically cash flows, and you're going to have a lot less risk of that deal going wrong. And oftentimes it's people that are just getting into this game and into this world that are trying to find these creative strategies that don't yet have the knowledge or the experience to recognize where they might be making errors. And their risk just continues to grow because they don't have that experience. The more riskier of a deal you're in, the more at risk you are to mess it up and lose money.
Yeah, I think when I advise people what to do, I mean, I just tell them like, look, you can kind of do the safe, slow and steady race the way I did it and not take too much chances. And we can put it on a spreadsheet and we can be like, all right, you'll be there in 7 to 10 years where, where you can probably quit your day job if you're able to save 30, 40 grand a year, buy a rental property every year or so. Or you can do this burr thing, like you said, put sweat equity, take a lot more risk going back to zero at any point, but you'll get there in 4 years. And
Exactly.
To me, it's just not worth it. But hey, it's other people's lives. They can do whatever they want. But,
And I think
choice.
100%. Knowing what you know today, if you were looking back and you were looking back 12 years ago, what would you tell your 12-year-old, your prior self? Would you change anything, or would you have done something differently? Because I think, I agree. I think that slow and steady wins the race, and people don't weigh the risk reward enough, because people just look at the upside and they never look at the downside. And risk reward is an important part of investing. The way you did it, would you have changed anything, or what advice would you have given yourself 12 years prior?
I think I probably would have done the same. I mean, people ask me all the time, what would you have done today, if you knew everything you knew? But of course, that's not a real life question, right? Because you don't know the people. You would have never gotten the opportunity to build a relationship with the network I know now. But if I would have done it again, I probably would have bought a few rental properties at a state, got the gist of it, and then went straight into private placements and syndications and, large multifamilies. But that's all in hindsight. But I would say by getting 5, 10, 11 rental properties, that was kind of a real big pain in the butt, especially to unwind. I mean, I had to sell 7 of them back a couple of years ago. I sold a couple of them last year, and I still am trying to unload the last 2 this year. And it's just such a time suck, that stuff.
Yeah, I think there comes a time where dollars and returns start to go the other way. So when you first start, you want to maximize returns, you want to maximize the little dollars you have. But then what happens is as you start getting more and more capital, more and more dollars, the percent return becomes more and more less important, and the overall dollars and time becomes more important. So to your point, those single family homes could be doing very well, but it's just not worth the headache. It's not worth the time. It's not worth the money it generates. The time value of money for you just doesn't make sense anymore, but those could be great deals for somebody else. So I think it's directly comparable to when people say, oh, why do these massive funds look for 3, 4, 5% returns? It's because, well, that 3, 4, 5% on, $100 billion is a shit ton of money, and it works. So I think as you kind of move up that hockey stick, I'm sure your outlook changed on a lot of things you were looking at as well, right?
Yeah, like another thing that I recommend folks, it all starts where's your net worth, right? How much money are you able to generate at your
100%.
day job? I think the threshold is if you're able to make at least 80 grand, I consider you a higher, net worth guy.
Mm-hmm.
If you're under there, look, I'm probably not the guy to follow and emulate, right? I'm a higher paid professional. Engineers, we don't get paid that much. Probably why there's so many damn engineers investing to get out of the rat race. But
sure.
If you're above that threshold, certainly above 6 figures, don't go buy a duplex, triplex, or quad, right? And I think that's one of the advice I give. It's a shocker because people look at it just from a paper standpoint, and the duplex, triplex, or quads, they'll be a little more cash flow generating. The numbers are certainly better. You're going to get higher rent to value ratios on those. But I tell these guys, look, you're not going to hold on to these properties for longer than 5 years. You're going to sell those things and parlay that into bigger deals and re-leverage your equity.
Mm-hmm.
And those duplexes, triplexes, or quads, the exit strategy on those are horrible. They're going to sit on the market forever. And what's worse is you're only going to be able to sell that to another cheapskate investor. The next one that's born next month or the next few years. Whereas the single family home is a quick unload, and you can, the whole point of that is you can sell it to unsophisticated emotional buyer.
Mm-hmm. No, it makes a ton of sense. So I'm sure a lot of all of what we've just talking about is what led you to kind of transitioning into more of the bigger multifamily mobile home park investing side of stuff, right?
Yeah. So I realized when I had 11 rentals that I was just spending too much time on it. I was around 3 or 4 locations, 3 or 4 property managers, and just managing those relationships were kind of being a little bit of a time suck for me. I was having an eviction or 2 every year, and some kind of big issue that happened every quarter, which is not bad. 10, 11 properties, probably could have handled 20 or 30 of these things, but 20 or 30 of these properties is not even $10,000 of passive cash flow a year. That's just not enough for me. So begin with the end in mind, as they say, and don't do anything that you can't scale to 7 or 8 figures is another thought. So that was where mainly I saw other people. I started to join different mastermind groups, and I started to realize what other people were doing out there. And they weren't doing these. I had this all in my head. I was going to put 10 rental properties in my name, 10 in my spouse's name, get Fannie Mae'd out. And when I got into these rooms with other higher net worth investors, they all thinking that was the stupidest thing in the world. And then I started to adopt that mentality because I saw the light. I saw what high net worth guys were doing, and they were investing in these private placements and syndications where they knew the operator. They knew how to underwrite the deal, and they would spread around, 50, 100 grand increments into dozens of deals over different geographic areas, different partners, different types of deals, different asset classes. And they were doing it in a tax advantage way where, they weren't getting overwhelmed by capital gains by any, property selling.
Where, when you invest in these, or when they were talking about it, what were things that you looked for, and what were mentors and mastermind people telling you? Just for people listening, if they decide that it's the right option for them, what are you advising people to look for in an operator, in a deal, so you don't get smoked with taxes, or you can take advantage of depreciation and write-offs. What are things you look for?
Yeah, so my due diligence process on operators and who I work with is 50% the person and 50% the numbers. So the person is, I've gotten burned a couple times with just investing off of some, random email or daisy chain deal, or I put this or in one case, a self-directed IRA recommended to work with this certain operator. And that's just that you shouldn't do that.
I was going to say that's typically they try and avoid that situation.
This is back in 2012. I don't even know if this company is still in business anymore. I forgot which company it was, but I mean, as an investor, you want to build up your network of other passive investors. Talking to syndicators and operators does you no good. It's a waste of time, in my opinion. I mean, I can talk about this stuff in my sleep. If you're a passive investor, you want to find other high net worth passive investors to build real relationships with and figure out, you want to have those conversations that, hey, you put in 50, 100 grand with this guy. What actually happened? Right. And unfortunately, when you're starting out, you don't bring any value to that conversation. So it's going to take a while to get going. And the local RIA or the online forums are some of the worst places to go to, because you're just a bunch of broke people on that stuff. So I don't know where to go. I can't really give any practical advice on that, but you've got to get around high net worth accredited guys and guys who are actually doing this stuff that don't have a dog in the fight in terms of getting some kind of marketing fee or referral fee or whatever, and go off of that. That's the gold standard. Like, I mean, people will bring me deals all the time, and I'm like, well, first question, you know what I'm going to ask? Who the F is this guy? How do you know him? Have you invested with them in the past?
So that's an interesting take. So I don't think most people, they like to flip to the back page and see what the return is, and then they invest, and then they've made their own bed, right? Whatever happens, happens. I think it's very important to talk to other investors and find out where they're having success, right? Because you want to go back to the well, and you don't want the well to dry up. But if they're investing with someone over and over and over again because they're, proving it out, those are people that you want to invest alongside with. You said, they say your net worth is similar to the 5 people you're around. So it's an interesting take on investing, because most people say, well, just keep looking at different deals and underwrite the deals. But I always make the argument that, the person that's going to battle for you, that's probably at least 50% of the battle, right? The deal is the deal, whether it's a good deal, bad deal, that's for another conversation. But who's the team or the man behind the deal or woman behind the deal? Because that's what's going to make the deal work, right? It's how they can manage an onsite. It's how they, how they buy it, how they found it. And I don't think people weigh that nearly high enough when people just want big, huge, massive returns, and they're not asking themselves those questions, because those are the questions that are really going to matter when things don't go well.
Yeah. I mean, I think like a lot of the podcast advice or the top of the funnel advice is like, invest with the right people, right? But if you're new, who the heck is a good person, right? Who has the best fan likes on Facebook or something like that? You don't know, right? And oftentimes the people who are good at marketing aren't the best operators. I mean, you can't be good at both. I mean, you shouldn't be good at both. If you're good at operating, you shouldn't be screwing around with a really good marketing scheme. So the other half is the numbers, right? But unfortunately, when you're looking at a pitch deck, there's nothing in the pitch deck that tells you if it's a good deal or not. I mean, there's very little times that the operator will even put in reversion cap rates, what full economic occupancy is, what is the rent escalators per year. And luckily, I know how to underwrite the deal, so I can cut through all the garbage and decode the code. But I would say 95% of LPs do not know how to do that, which is why I see the whole thought behind, investing with the right people, because that's all you got, right? But if I'm saying, well, if you're going to do that, you can't underwrite the deals. You're going to invest with the people. Just make sure you invest with other people that you trust, that have vetted them in the past. It's kind of like, it's kind of a silly analogy, but like, you come to an intersection and the other guy on the left side is making the left turn. you can't see past that car, especially if it's a truck, right? And you're trying to make the right turn.
Mhm.
You know, if they're gonna go, you figure that they checked and they're gonna, their driver's side that's gonna get whacked, right? So I go.
No, I know exactly what you mean, right? And it's also too, if they're going, they're also shielding you a little bit too.
Yeah, exactly. Or we could all be screwed.
Yeah.
But that's small chance of happening, right? And for accredited investors, unfortunately, in the beginning, you just got to take a chance with 50 grand. I mean, it sounds very reckless and irresponsible, but that also helps you build up a track record and some good or bad deal. Even bad deals is good to have in the beginning, because now you can use that to build a relationship with another accredited investor, and you have some war stories to talk about, and you have some value to bring to that.
I joke around, but I'm not really joking. I tell people the best thing you can do potentially for any individual is lose money. I mean, invest in something and it not go well, or buy something and mess it up, or because you've been battle tested, right? Where it's like, okay, what did I do wrong there? Oh, you know what? I didn't vet the sponsor. I didn't look at anything. But the worst case scenario is you're going to lose your money. And if you go into it with that mindset, I agree with you. And I joke around and I tell people, listen, the worst thing you're going to do here is going to lose your money. So invest what you feel like you don't care about, or not that it could be $5,000, it could be 5 million. It doesn't matter. But I tell people all the time that, whether it's investing with us or investing with somebody else, how do you know if it's a good deal or a bad deal? You don't. And if it's your first time doing it, it's like anything else. You got to put your toe in the water and test it out. So when people ask me, the first deal you bought, how do you know it was right or wrong? And the answer is I had no idea. I took a shot. Whether you buy your own duplex and you think it's going to cash flow, or whether you invest $50,000 in a $5 million syndication, there's no right or wrong way to do it. But doing it will just it's one level of accreditation from a standpoint of when you're talking to another investor, you have a battle story to tell them. When you're looking at a deal, you could say, oh, wait, this looks very similar. It was in the same market that I did it once before. And so I think it's another unique perspective that people don't talk about. But I do think there's a lot of, validity in just doing it and seeing what happens. And when you first start, you have no other options, more or less.
Yeah, it's like we're playing a game of, was it Minesweeper? When we're like just clicking the button, and maybe if you only have 50 G's to throw at it, you only get one slot at it, and you pick the red mine. That's awesome, right? People want to know who the shyster is out there, and I would like to know. If anybody knows, shoot me an email. I'd like to know. I trade who's in my burn book.
No, 100%. I mean, that's the power of the network. Because as big as the commercial real estate and real estate investing world is, when you really break it down, it's relatively small. And if you do the wrong thing once, that's going to get out there. And I was talking to my cousin the other day, and he was talking about investing, and he's like, I got 25 grand. What should I do? I said, go on a website and invest 5 grand into 5 deals. See what happens. See, what you like about it, what you didn't like about it. But you're right. If there's someone out there not doing the right thing, let me know, right? Because then it's ammunition from both standpoints, from the investor standpoint and from the sponsor standpoint, right? You're looking at saying, oh, wow, another one of those deals. Like, I'll just pencil that for when it fails. So it's important to network and to take gambles and to take shots.
Yeah. So I have a question. When you were transitioning to more of the passive investing LP side of things, what was your thought process on giving up control of your money versus having your own deals that, you have control over? You can decide whether to sell, you can decide whether to hold, refinance, things like that. How did you deal with that?
Yeah, I mean, initially when I was going from a direct owner to more of a passive, I went to this phase, and I didn't go through it for very long, maybe about 6 months, where I was overcome by ego, right? I wanted to be the guy, right? Mm-hmm. And there was part of it is you see these guys running these big deals, and you're like, oh, that's cool. So secretly you want that, right? Aside from all keeping the whole deal for yourself, having control. But, me and my partner, we wanted to pull our money together and just go buy a 50 or 70 unit in Dallas. And because that was all the money we had. But then when we got to it, we started to analyze deals, and it just took about a 6-month process of kind of going through enough and realizing that these deals suck, right? Like every mom and pop investor can't get above that 100, 200 unit mark. and we're competing with them, and then the pricing is worse. It didn't strike home until we're doing this for quite a while, and then the property manager that we were going to use was just like, yeah, man, like the pricing sucks. It doesn't work because there's so many other loonies like trying to do the same thing. And this is where, I mean, we could, and the second thing that really knocked us out was we need other people on our sponsorship team who had Fannie Mae, Freddie Mac experience. Because I like stabilized deals. So I got to go after, non-recourse debt, and you need the Fannie Mae, Freddie Mac cards to do that. So that was kind of the straw that broke the camel's back. But, it's just the pricing doesn't work until you get above 60, or actually certainly over 120 units. I mean, I have a 50 something unit, and that thing is just, it's hard because we have more of a residential property manager, but everybody talks about like the 60 units is the threshold where you can get the property manager in the office, which is great. But to me, you really need their right arm person, which is the dude driving around the golf cart that knocks out little work orders without having to pay a third party. That's the person that's actually going to make a change, a difference, right? Having somebody just sit in the office all day long isn't going to do much. So I went through that situation, and then I started to get it. That's where the network came in. And I started to get, assimilate and kind of absorb their mentality, which was more, all right, you're giving up control, but you're getting back in so much more in terms of diversification. Now you can just spread your money around so much, different partners, different deals, and just to me that gain was way more than what I got just by having that little ego boost of I did everything.
Gotcha. So then if I'm hearing you right, basically what you're saying is because you're so diversified across assets, operators, regions, you feel that any control you've given up is just diversified away and not really a large risk for you.
Right. I mean, I grew up knowing that you have to give up something to get something, right? I didn't get everything I wanted. I mean, it's just like some investors, they want cash flow and capital appreciation. It's like, dude, you either got a development deal where you get no cash flow for a few years and get a big pop, or you get cash flow. I mean, you can't have everything. And this is just another example where you can't have it all. You got to make some decisions in life.
Yeah, I hear you. So how do you make sure that you're not too exposed to any one element of those different things that we just spoke about?
I would say just the way I've done it, and I still do it, as I kind of dollar cost average. I don't just like blow all my money in like 6 months. I guess in the beginning I kind of did because I had a lot of cash because I had sold some properties. But especially today, I kind of go into a deal every quarter. It's more, it's like a baseball player. Like I'll swing at it every 4 pitches. There might be some good ones. Probably won't be some good. I mean, if it's good, I'll swing twice in a row. But for the most part, I'm kind of controlled, and I kind of just dollar cost average my way through this. But I'm at a point where my deal flow is pretty consistent, and I kind of know where the water line is. I know what a good pitch is. I know what my buy box is.
Gotcha. So do you feel like you're almost investing in like the commercial real estate market versus particular deals, or do you still feel like you're investing in particular deals at this point?
I mean, I'm invested in the commercial markets that I think are strong. Like I don't invest in retail or assisted living. I mean, I have one deal in assisted living, but those are obviously markets that are taking a beating with this whole COVID stuff. But at the end of the day, I'd like to think that I invest in individual deals, right? Outliers. Right? We have a lot of investors who spew off a lot of statistics, more macro statistics, but it's always the sub-market, like where is it in the neighborhood, which transcends all data. I mean, that's the whole point. You want to buy outliers, right? I mean, hopefully that's how people think of their spouse, right? It's not an average guy or gal, right? But someone who's kind of special, who would have figured, right? Exactly. But I'd, find those deals once a quarter.
Oh, that's good. So how do you then, when you're looking at deals and you're looking at the submarkets and some of the stuff that you think pops out, what are things that attract you? What are things that attract your eye? Are there certain things you look for? Are there certain things you just totally remove? What are some of those?
Yeah, so my secret is I don't really fall in love with a deal. I just put in my spreadsheet and I analyze the property myself with my own assumptions. I get the P&Ls and the rent rolls. Again, this is something that most LPs can't do. So they're gonna have to go on a date and fall in love and like the smell, like what they look at.
Mm-hmm.
But I try and take that out of the equation. I look at it from the numbers perspective first and see how fat it is, and are the sponsors taking enough cut or not enough, or are they getting greedy with and then I look at like the splits and then the fees. But from the project level, is the deal fat enough first?
Mm-hmm. No, I think it's important, and you bring up a good point, and you touched on it a little bit earlier in the episode where John mentioned a lot of people just look at their returns, and I just think most people don't have the capability to actually sit down and properly examine a deal like you're doing, talking about looking at a rent roll, looking at a set of financials, putting it into a model. You said 2 or 3 things like rent escalators, reversion cap rate. I would bet 80+% of our investors probably don't even know what we're talking about.
Mm-hmm.
And for anybody listening who doesn't know, it's basically how much you're growing rent every year for income and how much you're increasing, or your reversion sale cap is when you sell. So what did you buy it for? What are you selling it for? And, I just think a lot of people, and I guess escalators could be expense side too. A lot of people just don't understand the mechanics behind a deal, and they don't understand how to properly analyze it. So when that information isn't included in a pitch book, they don't know what they don't know, and they don't know what information to ask for to be able to sit down and properly look at it. And the other thing too is, I'm sure you spend a lot of time looking at deals. If you're investing every quarter and you're only doing 15, 20, 25% of the deals you see, it probably takes you a good chunk of change every quarter to look at a few deals and then finally pick the one you like. I'm sure there's some you go through very quick, but I'm sure there's some you spend a good amount of time on. And for somebody that is working a 9-to-5 job, has a family, wants to do other things, they probably don't have the time to sit down and go through the massive deals that someone like yourself is going through.
Yeah, but I think if you know what you're looking for, it's super quick, right? Mm-hmm. For most LPs, they get a daisy chain deal in their inbox. They're looking at that thing for like 4 hours, right? I'm sure you know when people are looking at the damn email and they're clicking 200 times, right? Like, but it's the guys who know what they're doing. They only look at it for 2-3 things, and they already kind of know what they're working with, right?
Yeah. No, I think it's, the people that are looking quickly, I think, are probably looking for certain aspects, and then they find it and they're able to move. But again, I just don't think a lot of people have the same experience that someone like yourself has, and are able to sit down and properly analyze some of the different factors that go into it.
I don't think it's that hard. Like, I'm sure anybody would teach it to anybody for a couple grand, $400, $500 billable hours, right? It doesn't take that long, but nobody's willing to pay $2,000 to anybody unless you're in that breed that pays 30 grand for all these random coaching things. Yeah.
So Brian Burke, who manages a good chunk of units, he just wrote a very good book. What is it? That's what exactly. I just finished reading it. I have it over here, I'll give him credit for it. He hasn't been on our podcast yet. But he's in a mastermind with me. He wrote a book. I bought it because it's how to be a passive investor. It was like $45 maybe. So you're right. You can teach yourself how to be a passive investor, right? The questions you should look for. And we're not talking about major, you could click it and review it and read the document, but you're right. Lane's right. There's 3 or 4 things that you should look for to tell you if you want to move forward or not, right? You shouldn't go through everything with a fine-tooth comb out of the box. You can spend less time on it, but you have to educate yourself. You have to know what you don't know, and you have to find the resources to learn it. So that's a great book to how to be a passive investor, questions to ask, things to look for, to understand if the sponsor is worthy of your time. But question I have for you, I know that engineers have a different way to look at things, right? Does that help, or do you think it's helped you make your decisions quicker, or the way you go about deciding, I gave up control, but look at the diversification I got? Because, I have very good friends that are engineers, and they bring an element to any decision just from laying it out, structure, organization, detail, they just do it better. I don't know if that's from the schooling and the way that you were taught, but do you think that's helped? Or are there any tips or recommendations you can give as a former engineer or current engineer or with that background, where someone can look at a deal and go through something quicker, or speak to how that's helped or potentially hurt the decisions you've made?
I think engineers, they don't get afraid by using Excel, spreadsheets. That's number one. But, this real estate stuff isn't that difficult. It's not rocket science. I think most engineers, they get the analysis paralysis. They know a little bit too much to be dangerous, and they just overwhelm themselves. But I think maybe since how I've been so successful and how I've kind of used that to my advantages, like you need to look at the KPIs. What is the few things in this whole mess that actually matter or matter the most, right? Like for example, something that I don't really know too much about is like non-performing note investing, right? I mean, this is just kind of an example of kind of learning something new. I mean, I go in, I'm looking for the KPIs. I'm like, all right, you have a spreadsheet of all these things like amortization period, interest rate, how much your unpaid balance is, blah, blah, blah. And I'm like, okay, what is here that are the one or two things, the 80-20 rule that I need to pay attention to? And then I'm going to kind of monitor that in the back of my head. And that's how I'm going to learn it.
So that's extremely wise and important for anyone listening. 80-20, you can get 95% of the way done with something by realizing that only 20% of the stuff is actually of value and 80% of it is crap. And if you can figure that out quicker, no matter what you do, whether you're a school teacher, whether you're the president of the United States, or whether you're a real estate investor, by using that principle, you can sift through shit pretty quickly once you understand the important pieces of any puzzle. So I think that's, awesome advice to listeners, not only vetting sponsors and looking at deals, but even looking at your own deals, right? Look at the quick things and say, okay, this is not worth my time. I'm done underwriting it. Don't fall in love with it, because that's the stuff that's going to allow you to become better at what you do, no matter what you're doing.
John, you like that book, or I mean,
I wanted to. Brian's in my mastermind. I thought it was important. Obviously, I read it for a couple of reasons. One, I want to see how he's presenting himself to investors. So, as a competitive individual, I thought it was good to see. I think the 100 questions or 70 questions that you should ask a sponsor. I saw that just so I'm using it as a tool for not only my own business. Okay, this is what the competition is doing. How do we do it better? And I would tell him that to his face, because I'm a super competitive individual. I think that he put it out there. I mean, it's a tool, right? I recommend Joe Fairless's book all the time as well. The best apartment book ever, because I think it's a good blueprint. I don't think anyone should hold their hat on any one resource. I thought it was good. I thought it was solid. I thought there was good value in it. Some other things, there's probably some extra wordiness to it that you probably don't need. I think you can probably do it quicker, but inevitably, people like longer books for whatever reason, or medium-sized books. I think you can answer a lot of those questions a lot quicker, but that's not the purpose of writing a book. I don't believe. I barely.
Write a book is for marketing purposes for investors. That's why you write a book.
Exactly. So I think that there was definitely some stuff there, but I think it's a tool, right? It's like a carpenter. If you give him a screwdriver and you tell him to nail a nail in, he's not going to be able to do it. He's going to say, I can't do it. But if you don't know how to use the tools that you have, that's shame on you. But if you have all your tools and you know how to use them, you're going to make more informative decisions. So for me, it was a competitive advantage. Read, not necessarily something that I thought was like gospel or Bible, but I thought it was, it does talk about some things that are interesting. I also think there's some things in there that are probably a little bit higher level than most passive investors will ask questions. But for the most part, I think it's a tool for $50 that you could probably read through, and it'll probably, for a passive investor or potential investor, I think if you read through that book for $45 or whatever it costs, I think you may get a series of questions that you never thought to ask going into a deal. And I think if that's what you need to feel comfortable, it's worth the $50. If you think you're smarter than everybody, then obviously don't buy it.
I just think in like those books, I haven't read the book. I don't really read books. I would encourage people to like analyze more deals and read books, but
I agree with that.
there's more like black and white knowledge and gray area knowledge. Like the gray knowledge is kind of like the questions, what do you ask the sponsor, like the soft stuff.
Mm-hmm.
And the black and white is like the more numbers, which I'm sure they don't really go into in that type of book. I think the black and white stuff, you need a coach to kind of look. I mean, that was how I did it. Was somebody like I analyzed it, put in the spreadsheet, and then they're like, oh, you can't do that there.
Mm-hmm.
And I'm like, well, I would have never known, right? If nobody corrected me. And then the other thought I have with that, those questions, the 100 questions, this is why, oh, God bless engineers. Please help them. But like the engineers, they're not the best social people, right? Like they ask all 100 freaking questions, and they'll quickly get their name removed from the said investor list, right?
So it's funny because he does a good job breaking stuff down, and I recommend the book to people that need education, because there are some people that refuse to pay someone to teach them something, which that's fine, right? Some people like to do it themselves, and I think it does a very good job at that. But you're right? It's someone can teach you to weed through the shit that's irrelevant. And if you ask, I'll tell you right now, someone will call me up and I have 100 questions I'm going to ask you. I probably won't take 100 questions. I'll probably say you could ask me 10, right? Like,
what if you had $10 million?
You're right. I should ask that
Maybe
question
50.
first. How much are you going to give me, right? No,
Yeah.
but, no, 100 questions is a lot. And I think that, you could probably ask the same amount of questions in 10, because I don't think if you're asking 100, that means you really have like 800 questions you want. Pick the top 10 that are going to get you to the decision point, right? Because I had this conversation yesterday talking about a deal. I said, you got to get to a decision point, right? There's possibility and probability. If you're hanging your hat on possibility, there's nothing wrong with that. But your likelihood of success is significantly smaller. If you hang your hat on probability and you take the actions necessary to get to a decision point, shit or get off the pot. But if you just stay in that position for a long period of time, that's probably why you're missing opportunities. You're not underwriting deals quick enough, is because you're always trying to figure out a way to, the grass is always greener on the other side. So I talk about it all the time. You want to get to a decision point by asking the right questions and then make a decision. Am I going to go forward or not? But when you just hum along and kick it along, all you're doing is you're kicking the tire down the road to probably making a decision you're going to regret, or you're never going to make that decision. So that's why I said earlier, and I agree with you, sometimes the best decisions you can make are, I put 25 grand into a deal and I lost it. Because if you don't learn from that mistake, you're going to lose a lot more money. But if you say, wow, what did I miss? And you educate yourself on what you missed, you probably won't make that mistake again. And it goes the same thing with buying deals. You buy a deal, oops, I forgot that. I'm not going to forget that next time. So I think that whether you're a passive investor, active investor, looking to do this full time or not, you got to get to your decision through the right analysis, but you got to get there relatively quickly. And I'm not saying you need an answer in 12 minutes, but you got to be able to get to a decision and feel confident in that decision that it's the right decision. And I think that's the part where a passive investor, an active investor, that's where a lot of people fail, because they get analysis paralysis and they never get.
Yeah. I would say one question per every $250,000 net worth.
I'll take that. That's
New rule of thumb.
Yeah.
Some of our biggest investors don't, now that they've invested with us over and over again, it's what do you like about the deal? It's in, best school district in the, okay, done, good, right? But, it's the person that invests $5 grand that asks 200 questions. And then after you buy the deal, he wants to know what the occupancy is every 2 minutes. That's just, that's sort of the 80-20 rule of investors, right? 80% of them, they are what they are. 20% are probably going to be your bread and butter. So, and that's very honest for anyone listening. I basically just shit on 80% of the people, but unfortunately that's life, right? Life's not fair. So, people got to understand that.
Yeah.
Yeah. I think a lot of that just comes from, people with a lower net worth or early on in their investing career, they're just putting more capital or more percentage of capital at risk in those deals. So they're less comfortable in giving up control. That's why it was really interesting for me when you were talking about being pretty much okay with just giving up control, Lane, because you've got money spread out in so many different places. You don't need to know the occupancy of every single deal every 2 weeks, because you'd be flooded with numbers and too much information. It's not worth your time. That the deal is going to either perform or not, and you're diversified enough, it's not going to matter. I'm sure it's the same scenario for a lot of people where it's their first deal, or they've got 2 or 3, and the lack of control is newer, so that information is much more important.
Right.
But it's a good point, because even to that point, we have extremely sophisticated investors. They don't even want quarterly reports. They don't want to see it. They don't, I don't want to say they don't care, but then we have other investors that, are requesting financials every month. And I'm like, okay, yeah, you're an owner, I guess so, right? I have no problem with that. But it's amazing to understand the psychology of investors, because you're right. It's, if I take the necessary precautions to make the investment, some are going to work, some are going to be great, some are going to be okay. But for the most part, I have the diversification I need. Others, they seeing the financials, and I say, seeing the financials for the last 30 days, how the fuck is that going to tell you what to do anyway? Right? That's 30 days in the rears. For all you know, how does that help make a decision for the future? Because your financials are a backwards look at what's going on. So you're already, I'll send them to you, but is that going to make your decision? What's it going to do for you as an individual in the deal? And that's something that maybe people don't like the realization of it, but the financials are an important piece of any deal. But as a regular average Joe investor looking at it, what story is it telling you? Especially if the business plan was a value add or whatever it is, but you want to understand it. I get it. But it's 30 days prior, right? You get your financials 15, 20 days in the following month. A lot's changed over 3 weeks. So, but that's my 2 cents.
Yeah. I think that's just investor psychology is like, especially if they haven't received any distributions back, right? I mean, they're kind of wondering, well, are these guys legit? Especially if they haven't invested with you in the past, or did they run off to Mexico with it? They just there's that uncertainty, and yeah, I guess you get it. I mean, I don't know. It's just hard, but it's just, I don't know if you ever had the time where like a guy, he's like, you just closed on the deal on Monday, and on Tuesday he says, I'm out here at the property. I see a light out. It's like, dude, we got like 5 years, man. Chill out.
So it's funny. We did a ground up construction deal where we had someone that literally asked us about 6 months into the project, when's this, are we getting a distribution this year? I was like, well, I think you didn't read what you invested in, because it's ground up, right? You want a distribution? There's a hole in the ground. No one's paying us rent yet, but it's amazing how you're right. Like, there's a light out. That's okay, right? One light, we'll fix it. We're on top of it. We know about it. Most likely we know about what's going on, but you're right. And then once you give a distribution, no one asks any more questions anymore. I don't know why. It's the psychological, it's the mindset. Someone's like, oh, I got to check. I'm good. These people are real. But meanwhile, some of the best deals we did had no distributions. It's amazing sometimes how you get emails and you look and you're like, well, you just question things. Like what went into behind that question? So I don't know. It's super interesting. Obviously you come from a different, doing it and being in it for so long, you probably see, you probably understand it a lot better. But I think that investors should strive to get to that point, whether it's networking with other investors, whether it's, whatever it is. But I think that, educating yourself is important, whether you're paying a mentor or a coach to educate yourself and or networking with other investors. But I think people have to do a better job at that, because over the last 12 years, 10 years, 7 years, it's been hard to make a mistake. So people aren't they're not learning from wins. They're expecting everything should go as according as how it's gone, which, maybe that's the case, maybe it's not.
Right. And I think those outliers are the guys who are usually a little loners. Like they don't have the people around them, I think. Mm-hmm. If that's the secondary ingredient. And, like I said, the gold standard is go into a deal where you already know a buddy who's invested with these guys in the past, that have gotten the money back. So you should be cool, right? Relax, right? Go talk to your buddy and have him console you, buy you some beers or something like that.
100%. I think that's really good advice. I also think that's a really great place to wrap up for this episode. Lane, thank you so much for coming on and sharing everything with anybody listening and ourselves. If people want to follow along, get in touch with you, learn more about you, where can they do all that?
They can check out my podcast, Simple Passive Cashflow. Kind of just following my journey over the past few years since 2016. And email is lane@simplepassivecashflow.com.
Awesome. We'll drop that in the show notes below. Thank you so much for coming on. And guys, thank you so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are subscribed, please send this episode to a friend, family member, or colleague that you think would really enjoy it. Lane, once again, thanks so much for coming on. This was fantastic.
Thanks, guys.